Hi everyone, I'm Sam and this is Pip.
Hi!
And welcome back to Money, Mortgage, Moving Out.
In today's episode, we're going to be looking at inflation versus interest and also different accounts to consider when trying to save.
Massive disclaimer, we are not by any means financial advisors.
No, we're just two people trying to buy our very first home. We have now found out how to make and stick to a budget and also different ways that we can save a little bit of extra money.
It's now important that we're saving our money in the right places.
Yeah, let's go.
In order to understand what is happening with your money and where your money is going, you must first understand interest rates.
Yeah. Interest can be classed as a reward you get for putting money in your savings account.
The amount of money the bank pays is based off the money inside your account.
However, interest rates need to be high enough to outweigh inflation, otherwise you're losing money.
Inflation is when the stuff we buy rises in price each year.
Inflation is calculated in many ways, but you'll most likely hear about consumer price index and retail price index.
These are compiled of a survey of the rise and fall of consumer goods and services in a little basket.
Yeah. The RPI includes housing costs and is calculated differently to other things.
So the rates are not the same. Usually the CPI is lower, and that tends to be the national statistics of inflation.
The Office of National Statistics works out the rate of CPI based on goods and services that are thought to represent the population over any given year.
They do this online or over the phone to figure out how the prices have changed, if they've risen or fallen.
Yeah.
Through the years, the thing in these baskets of goods have been a variety of different things based on popular demand in the UK. The inflation rates are recorded as percentages, and this percentage is the increased amount from the previous year. So higher interest rate induces people to spend less and save more, which tends to bring inflation down. Basically, inflation damages cash savings, which makes it more important to try and save them with generous interest rates.
Many savings accounts do pay less than 0.5% of interest. And since the credit crunch, interest rates have dropped to a historic low, which is actually quite good for small business owners and homeowners with mortgages, as they're able to borrow with cheaper interest rates. But it does mean that saving is far less lucrative, which is a problem for those trying to make a profit and get on the property ladder.
Now we know a little bit more about interest rates and inflation. Let's take a closer look at some saving accounts to consider.
The chances are you're still using the same current account that offered you a free rail card when you were a university fresher.
But there's nothing wrong with this. You just might be able to make a little extra money by switching accounts occasionally.
And with saving rates so poor, some current accounts offer attractive interest rates.
Many banks now offer a cash incentive for you to switch to them, or they could use a voucher or a gift.
Yeah. You can also have more than one current account.
If you travel a lot, it might be worth looking for a debit card that doesn't charge overseas fees.
Yeah, and if you're prone to going into your overdraft, maybe look for the current account with the cheapest one.
Many people are put off about switching current accounts because they think it's a hassle.
Actually, you can do this automatically with the current account switching service. They guarantee to move all payments going in and out of your account over within 7 days.
So there's no ringing around to let people know.
No. When you open a new bank account, the new bank will close your old account and everything will move across within a week.
And any payments into your old account will be redirected for 3 years afterwards.
To get to know a few accounts a little bit better, we're going to do a quick pros and cons of each account. Easy access savings accounts. Pros, you can get hold of your money immediately and you can withdraw it sometimes an unlimited amount of times. Sometimes there is a cap, or they dock interest for the month that you withdraw. Cons usually offer the lowest interest rate, as you're paying for their flexibility.
Notice accounts. Pro. Like easy access accounts, you can take out your money whenever you want, without penalty, and they usually pay a little more interest than easy saving accounts. Cons. You have to give the bank notice before taking out any money, so it's not good for if you need urgent cash.
Fixed rate bonds. Pros, the best savings account for large sums of money and the one most likely to beat inflation. Cons, to get the rewards you have to lock your money away and can't touch it for a period agreed. And if this is something like 5 years, you'll miss out on any interest increases.
Regular savers. Pros. For smaller sums of money, they usually have the best interest rates of any account. Cons. Regular savers reward you for putting smaller sums of money into your account. You need to be organised and take advantage of these. So set up a direct debit to maximise your rewards.
ISAs. Pros. Normally, any interest you earn is taxed at the same rate as your salary. A cash ISA is a type of savings account that allows you to earn interest tax-free. You can save in easy access or fixed rate ISAs. Cons. ISAs have an annual limit to the amount you can save in them.
It's always important to keep the terms and conditions of any account in mind.
Always read the small print. There are a few ways that they can catch you out. There is normally a minimum deposit which can be quite high.
Some expect you to maintain a minimum amount of savings in order to receive the full advertised rates.
Watch out for bonus rates. They play on the reluctance to keep switching saving accounts around.
Many of the best interest rates last for only a year, then they fall.
If you want to keep earning more interest, you should probably keep monitoring your savings account and switch it up every 12 months or so.
We hope you found this episode interesting, and we hope it helps you get the most out of your saving accounts.
Yeah. The Martin Lewis Money Saving Expert has all the up-to-date rates and the best savings accounts with the best interest rates for you.
So before committing to a bank account, head over there and have a look.
Yeah. Or if you want to switch it up a little bit and change your bank account, that's a really great place to start as well.
We'll link all the websites that we use down in the description below.
Yeah. We've touched briefly on ISAs today, but we want to do a whole episode about ISAs as they are so important when buying your first home.
Don't forget, one of the best ways to beat inflation is to invest, but we're also going to do that in a separate episode, so
please put in the comments below if there is anything you want us to cover or any questions you have, or if you just want us to go into a little bit more detail on anything we've covered so far.
We are still on this learning curve as we're going through it now.
Yeah.
And some of these things are new to us as well.
Yeah.
And we're just coming along with the ride with you and just giving you a bit more information.
Yeah. But that's all for now on this episode. Please don't forget to like this video and subscribe to our channel. We appreciate your support so much and we're so grateful that you're coming on this journey with us.
We'll see you next time.
Much love.